Hey everyone, welcome back to Corporate Decoder, the place where we, decode corporate filings. Today we're diving into a report that involves a company shrinking, not in sales but in its stock. Get ready for some reverse psychology corporate style. We're looking at a filing from Sharps Technology dated April 25, 2025. This is a Form 8K which companies use to report major events that could affect investors. In this case, it's all about a reverse stock split. So what's a reverse stock split? Imagine you have 300 slices of pizza and suddenly you only have one giant slice that's the same amount of pizza. That's basically what Sharps Technology did. They took every 300 shares of their common stock and combined them into one share. The goal? To increase the stock price. This went into effect late April. The price of each share goes up because there are fewer shares available overall. Now, why do companies do this? Often it's because their stock price has fallen too low. Many exchanges like the Nasdaq, where Sharps Technology is listed, have minimum price requirements. If a stock trades below $1 for too long, the company risks being delisted, meaning their stock would no longer be traded on that exchange. That's not good news for investors or the company. The report mentions their common stock has a par value of $0.00001. Par value is a really low nominal value assigned to a company's stock when it's first issued. It has little to do with the actual market price of the stock. The company formally changed its official documents, its certificate of incorporation, to reflect this change. It's not just something they decided to do, they had to make it official. Finally, the report is signed by Andrew Crescenzo, the Chief Financial Officer of Sharps Technology. This signature confirms that the information in the report is accurate to the best of their knowledge. Now let's step back and look at the big picture. Reverse stock splits can be a sign of trouble. While they can temporarily boost a stock price, they don't fix the underlying problems that cause the price to drop in the first place. If the company's business isn't doing well, a reverse stock split is like putting a bandage on a broken leg. It might make it look better for a little while, but it doesn't solve the real problem. It's important to investigate why the stock declined in the first place and to solve putting a bandage on a broken leg. It might make it look better for a little while, but it doesn't solve the real problem. It's important to investigate why the stock declined in the first place. However, there are cases where a reverse stock split makes sense. For example, if a company is planning a major acquisition, having a higher stock price can make the deal easier to finance. Also, a higher stock price can make the company look more attractive to institutional investors, who may be restricted from buying very low-priced stocks. In the case of Sharps Technology, investors should ask, why did they need to do this? Is it a temporary fix or is there a real plan to turn the business around? What are the risks of investing? The company is an emerging growth company, which means they are smaller. In general, those companies have more upside but higher risks. Thanks for watching. Remember to hit that like button, subscribe for more corporate deep dives, and let us know in the comments what company you want us to decode next.